Let's cover the basics. Why should I invest and not just save money? Having savings is a good idea, but saving too much isn't, and you need to know why. Firstly, when you save money in your bank account, you might be surprised to know it's no longer yours. The bank now owns it. They agree to owe you this money, and you are hoping that one day they will have it when you want it back. The banks then lend this money out and invest it for themselves for profit. But mostly you need to understand debasement and inflation. Debasing currency is when a country prints more money, and the more of something there is, the less valuable it is. The more money that is printed, the more it goes down in value. Let me give you an example. Imagine you have a limited edition trading card that everyone wants because it's rare. You could trade it for so many things because the card is scarce, and scarcity creates value. If suddenly more copies of that card are printed and flood the market, each individual card becomes less valuable because they're no longer as rare or desirable. Similarly, when a country prints more money, each unit of currency becomes less valuable because there's more of it in circulation. Governments can print more money because their currencies are known as fiat currencies. Fiat currency is money that has value because the government says it does, not because it's backed by a physical commodity like gold. Its worth comes from trust and acceptance, not from any inherent value. It's literally just paper. Historically, this wasn't always the case. People used to trade precious metals like gold, which had a limited supply, and so it was seen as intrinsically valuable. Then people decided carrying around gold was not a great way to exchange value and buy things. So people stored their gold in what we now call banks, and the banks gave them slips of paper to represent how much gold they had stored in the bank. These paper slips could be traded, and when someone wanted to change the slips for gold, they could head to the bank and exchange it. This paper is what we call dollars today. In 1971, however, President Nixon ended this in the USA, meaning dollars could no longer be exchanged for gold in the same way. This shift meant that the dollar became purely fiat money. So, what does that all mean? It means the government can print as much money as they choose, and it does not need anything of actual value to represent it in a bank somewhere. Around 40% of all the dollars ever printed have been printed since 2020. A quarter of all global wealth is held in fiat currency, either in cash or bank accounts. The global debasement rate for currencies is around 14%, meaning if your money isn't earning you at least 14% a year, or your salary isn't increasing by at least that, unfortunately, you might not be able to buy as much as you did last year with the same salary. Now, let's talk about inflation. Inflation occurs when prices for goods, assets, and services rise over time. When more money is available, but the number of goods and services stays the same, people are willing to pay more for things, and businesses often raise their prices to match. This results in an overall increase in prices, which is what we experience as inflation. To measure inflation, the government uses tools like the Consumer Price Index, or CPI for short. The CPI tracks the average change in prices over time for a set basket of goods and services people commonly buy, such as food, clothing, housing, and transportation. By comparing the CPI over different periods, we can gauge how much prices have increased or decreased. However, it's important to note that inflation measurements can vary. For instance, like the CPI, the Chapwood Index also focuses on everyday goods, but often shows a much higher rate of inflation, being between 8 to 13% compared to the official CPI, which ranges from 1 to 4%. It's important to know inflation also varies depending on your geographical location. Between cities, for example, taking into account salaries, housing prices, and so on. Next time you buy something, just ask yourself how much you think the price has increased recently. So, how much should you save? For most people, you need backup savings. Backup savings is a financial safety net. It's money you set aside for unexpected expenses or emergencies. Ideally, you need between 3 to 6 months of living expenses, but do what feels comfortable for you. Taking into account both debasement and inflation, you have to ask yourself, if I just save money and they are printing it, making it less valuable over time and prices are going up, is saving really going to help my future self? Is the interest rate they give me at the bank going to really grow my money? That being said, where should you put the rest of your money? This is where investing comes in. The reason people invest is so their money makes more money and it offers the potential for higher returns than just saving. You can invest in a lot of different things, with one of the most popular being stocks and shares. Buying a stock or share is like buying and owning a small piece of a company. When you don't want to learn about investing or trading, people tend to rely on buying a little piece of everything. This is called being strongly diversified. This often includes things like index funds and ETFs. A popular index fund is the S&P 500, which is a collection of 500 large American companies. Returns on your money are on average between 7 to 10% every year. That means if you invest $100 and it makes 10% that year, you have around $110 the next year, minus a small fee. By buying $100 worth of the S&P 500, you are investing in all these companies at once. Your $100 is split many times and allocated to all these companies in different amounts. It's a simple and cost-effective way to own many companies in many different industries at once. It's like taking a boat trip to financial freedom. The boat is often sturdy, has been used many times, and has always found its way back when storms hit and disaster strikes. But it will take most people a lifetime to navigate the waters and distance to reach their destination this way. The slow and steady approach is safer, but means you hope one day you will actually reach your destination and have enough time to enjoy it there. Much of the growth and gains of the S&P 500 come from the top companies in it, and so it may be wise to look up which companies are performing the best and are allocated the most money. This way, you can buy only the companies that will likely grow the most, without having small pieces of many companies that don't perform well. There is also the option of concentrated investing, where you buy only a handful of single stocks. This is where risk and reward are highest. It's deciding to take the path of lifelong learning, emotional payments, and sometimes financial ones when things don't go to plan. This is like deciding to take the fast route to financial freedom through a jungle. Here, dangers are everywhere for those who don't educate themselves. You can lose yourself here, but you can reach financial freedom much faster and live a life you never thought was possible. Everything you need to begin is freely available online. The only cost is time and effort. There are genuine people online who can guide and support you on this journey, but before choosing who to listen to, you need to assess people's motivations. There will be people also in the jungle who want to use your money and resources to make their own way to financial freedom and leave you with nothing. They will try to convince everyone to buy the stocks they own while selling them at the same time, pretending they have already reached financial freedom. Ask yourself if the person you are listening to is genuine, has an actual credible background in investing, or if you just like their personality. Can you look back at the information they have given to others and see what came of it? Don't be fooled by those offering extreme shortcuts. Some things are too good to be true. Here are some of the basics of how to navigate the single stock jungle. You need to understand fundamental analysis, which is what to buy, and technical analysis, which is when to buy it. You need to learn about bear markets and bull markets, mean reversion, corrections, compound interest, resistance levels, and expect the journey to financial freedom to take at least 10 years. You must learn to manage your emotions when things go both up and down, understand investor psychology, and stick to a plan. Remember that just relying on your emotions and intuition here will leave you lost and running in any direction away from the dangers of the jungle, often at a high price. Buying stocks when you fear you are missing out on prices increasing, and selling stocks when you fear they are falling too quickly or are too low, is a sure path to losing what you have. Now, what about mutual funds? A mutual fund is like a big pool of money collected from a bunch of people who want to invest. Instead of each person picking their own stocks, a professional money manager does it for them. This manager chooses where to invest the money based on the fund's goals. When you invest in a mutual fund, you own a piece of the overall fund's investments, and any profits made by the fund get distributed among the investors. It's like being part of a team where everyone chips in their money, and together they try to make it grow. Despite the expertise of fund managers, not all mutual funds consistently outperform, for example, the S&P 500 or the broader market. Some funds underperform due to factors such as high fees and poor investment decisions. Then there are bonds. Think of a government bond as lending money to the government. When you buy a government bond, you're basically giving the government some money. In return, the government promises to pay you back the money you lent them after a certain period. What do people mean when they talk about investing, swing trading, and day trading? Investing is like training for a marathon. It involves preparing for the long haul, pacing yourself steadily, and focusing on endurance rather than speed. Just as marathon runners train for months or even years to build their stamina and achieve their goals, investors aim for long-term growth by patiently holding on to their stocks and shares and allowing them to appreciate slowly over time. A slower pace often means a safer outcome. Swing trading is like running a middle-distance race, like a 5K or 10K. Traders are focused on achieving their goals within a moderate time frame, buying and selling assets typically in days, weeks, or months. They may not be in it for the long haul like marathon runners, but they still need to maintain a steady pace and endurance to reach the finish line. They often benefit from faster profits, but moving quicker increases the risk. Day trading, on the other hand, is more like sprinting in a 100-meter dash. Day traders aim to capitalize on short-term opportunities within a single trading day, making quick decisions and executing rapid-fire trades. Just as sprinters give their all for a brief burst of speed, day traders must be prepared to act quickly and decisively to seize opportunities in the market. They quickly buy and sell stocks during the day when prices move up and down. Doing this requires a lot of knowledge, with a high percentage of traders who try this losing money as a result. Even faster profits can be found here, but the risks are very high. These are just some of the very basics of investing and trading. Please watch my other videos if you would like to know more, and please like and subscribe for more content.